We're now going to take a look at tutorial week 9, focused particularly on IAS 37, provisions, contingent liabilities and contingent assets, and we're going to look at IAS 10, events after the reporting period. So we'll take a look at question 1. Again, I assume you've read through it. You're asked for two particular things. Discuss the accounting treatment for the 4 issues above, and where relevant provide the journal entries, and you must refer to technical guidance. So when we talk about discussing accounting issues, you have to say what's the standard and what's the principle within the standard you're applying. Otherwise, you're losing marks quite quickly. And then calculate updated net profit for RI for the year ended 31st December 2019. So we'll walk through each of the issues here. You're told the draft profit for the year was 585,000. So we know that's draft, and we said any of those 4 issues could update that profit figure, which is your Part B requirement. So you're told an interim dividend was paid halfway during the year. And at the board meeting in December, they proposed a dividend of another 105, but it won't be approved till after the year end. And always take watch for the question, has there been account of anything made in the financial statements to date? And you're told in this case, no. So first thing is to figure out what standard is relevant here. This is IAS 10. So IAS 10 is the relevant standard here. It says any dividends paid during the year are fine. They can be recorded. You're going to debit retained earnings, and you're going to credit bank. That's for the dividend that's paid. And you're just going to do that 105,000, 105,000. So that's a quite straightforward one. The one that was paid in the 1st July, there's no issue with that. It has been approved because it's been paid. Therefore, it can be put through. What we also want students to note is the dividend proposed but not approved at year end is not adjusted for under IAS 10. Only disclosed. And that's the key thing. That's all we're looking for in terms of issue 1, was that you realise there's a difference there between one that's paid, which means it's approved during the year, and one that's not approved until after the year end. So because it's not approved until after the year end, it's only disclosed. That's an IAS 10 rule that you're applying. That won't be accounted for until it's approved at the AGM, which is in the year end 2020. That's your first one complete. Debit retained earnings and no adjustment for the other one. Issue 2 then. We're looking at that on the 1st of January, the start of the year, RI completed the sale of one of its properties for 200,000, and it was purchased 5 years ago, 150. And the only entry that was made was debit bank credit revenue, and they had depreciated property 2% straight line from the date of purchase to the date of sale. So what we're looking at here is they've clearly accounted for that incorrectly. Now you can reverse that out and start from scratch, or you can just produce the net journal, and either of them should get the same marks. So we know when you sell a property, this is IAS 16. So these ones can be thrown in as well from time to time. We need to know the net book value at disposal. Because this is not revenue, you have to calculate a profit or loss on disposal. So you'll say the cost here was 150,000. And accumulated depreciation, so be careful now and read the question. You're told in this case that 1st of January 14 to 1st of January 19, that's all 14, all 15, all 16, all 17 and all 18. No depreciation 19 because you sold at the start of the year. So that is going to be 150,000 times 2% times 5. So your net book value there is 135 and disposal is 200. So that is a profit on disposal of the difference, which is 65. So that's how you account for a profit or loss disposal. Quite a simple one, but they can be easily thrown in as part of a bigger question. But you have to remember, you have to give debit and credit. You might say here, disposal of PP is not revenue, must complete profit or loss on disposal calc. Just to show the examiner, you're asked to discuss it, so you'll show them that I'm aware of the rules under IAS 16. So the first thing you're going to do is debit revenue, 200,000, because you're saying it's not revenue. Think about the other things you're doing now. You're going to credit PP cost, say that 150 is now gone. You're going to debit accumulated depreciation, 15, because that's now gone. And then you're going to credit the SOPL, 65. So what you have here now is 215 on the debit and 215 on the credit. Now there are other ways you could have went about that. You could have done it in steps. You could have used a disposal account. But your net journals, when you net them together, should come back to this. Your revenue goes down, your profit goes up, and the other adjustments to the asset-related items. So there are tricky ones that you understand. You explain the standard, explain the principle, and do the calculations out. So that was issue 2. Issue 3 then is dealing with a court case where there's an injured employee and the company is being sued. And Rise solicitors think it's highly probable that the company will be found liable, but they have an insurance in place, and even though the insurance claim is yet to be processed, it is likely that they'll get a reimbursement of about 50,000. And no entries have been made for 2019. So we're assuming this happened during the year 2019. So the first key thing here in your issue 3, and you need to make sure you write it down to get your marks. This is IAS 37. All right. In terms of the court case, this meets the 3 criteria for recognizing a provision. So this is the kind of language we're looking for you to do. If you're asked to discuss it, you must show your knowledge of the different standards. So what are the 3 criteria? Present obligation from a past event. So you do have a present obligation from a past event. Why? Because they're being sued. So the company here, the past event was the injury, and the present obligation is the legal claim. So that is met. The second thing here, is there a probable outflow of resources? And in our case here, it is, you're told by the solicitor, it is highly probable. So I put here court case. So it's highly probable, so that means as long as it's more likely than not, it's going to be allowed. And can it be estimated reliably? And it can be, because you're told 60k. So all 3 criteria are met there. So that means you should recognize a provision. You're going to debit the SOPL expenses. You're going to credit provision for legal case. And that is going to be 60,000. So that's important to understand that under IAS 37. Here, the 3 criteria are met. You explain why the 3 are met, and then you give the journal. So because it is highly probable, that means you meet the criteria to recognize. However, for the insurance claim, this is known as a reimbursement. And the key point here, you're only told it's likely. The insurance claim hasn't been processed. We don't know if the insurance company are going to have any complaints. So this is here. The insurance claim is not, and these are the 2 keywords, virtually certain. That's key under IAS 37. That means this is a contingent asset. What that means is do not adjust 2019 accounts, only disclose. And that's the key difference there, the key different criteria. It's important to watch out for. You do not adjust the 2019 accounts, you only disclose them, because this is not virtually certain. So for outflows, expenses, it has to be more probable than not. So it has to be greater than 50%. Virtually certain, you're looking up higher than 90%. So we have a different threshold to meet. And that's why it's often a popular one to come in, because you can examine both in the same type of question. So you adjust for the legal case, don't adjust for the insurance claim. So the last one then, issue 4. Let's have a look at it. So we're saying on the 1st of this year again, Rye purchased a mine for gold and paid 1.5 million. And as condition of the mining license, Ryan obliged to restore the mountainside to its original state in 6 years' time. Directors estimate the cost of restoration will be 600 grand in 6 years' time. and it commenced the first of this year, and the relevant discount rate is 8%, and they've no increase made. So there's two standards at play here. There is IAS 16, because of course you're buying assets, but there's also IAS 37, because what we have here is what we call a capital provision. It's a provision related to a physical tangible asset. So the obvious starting point is to debit PP and credit bank 1.5 million. Because you bought the mine, so you recognize a 1.5. But remember, under IAS 16, you are allowed to recognize the future restoration costs of a particular, so whether asset, whether it's a chemical plant, whether it's a nuclear plant, whether it's a mine or quarry, IAS 16 allow you to do that, to say, look, this is part of the cost of the asset, albeit it'll be in the future, but you recognize it at its present value. So you're going to say debit PP, credit provision for restoration. So just bring these out to match them all up. And what that's going to be is 600,000 divided by 1.08 to the power of 6. So the logic here is, in IAS 16 they allow you to recognize the future cost of restoration, but it must be at its present value. And that present value today, 378,102. So I'll just leave it there. It's 600,000 divided by 1.08 to the power of 6. So that means your asset for the mine that you're going to recognize is these two added together, 1.8 million. And that restoration would be a non-current liability because it's not due for 6 years, and also it will increase each year. That's a key point. So the first thing you're going to do is charge depreciation in the SOPL and credit accumulated depreciation. So what you're going to do there, be careful now, you're going to depreciate both of these because both of them are the asset. So you're going to depreciate the 1.8 million over 6 years. So that's how it works, is you get the present value initially and then you depreciate it like normal. It's the other side that increases the provision side. So about 313,000 a year on depreciation for the 6 years. And the one thing that'll catch students, that's just depreciation for 6-year life. But you also have to what we call unwind the provision. So you're going to debit SOPL, finance costs, and you're going to credit the provision for restoration each year. And we call this unwinding the discount. So what we mean by that is, that 378 is kind of a meaningless figure because the actual liability in 6 years' time is going to be 600,000. So what the standard says, you unwind that discount. So the difference between what you've initially recognized it, 378, and what it will be in the future. So that's about 222,000. So what you do each year is, you take the present value. So we'll take the year 0 provision. We said the year 0 provision is 378,102. And we'll say the year 1 provision at the end of year 1. There's two ways to go about this. The easiest way is you take the 600,000, you divide it by 1.08 now to the power of 5. Why? Because you're now 1 year closer. And if you're 1 year closer, that 600,000 present value is going to be higher. It's now going to be 408. And you recognize the increase, that's going to go through finance costs. And if you do that for 6 years, you will have the provision brought up to the 600,000. That's a tricky one, but that's how IAS 16 and IAS 38 combine, or IAS 37 should I say. So you will credit the provision, 30,000, debit the P&L, 30,000. And you'll do the same for next year and same for the year after, until you get to year 6, and the provision will now be up to 600,000. But it goes through finance costs, and that provision will still be a non-current liability because it's not due for 5 years. So they're tricky enough little ones that you need to watch out for when you're going through the question. And look at the IAS 37 question pack. You'll see 1 or 2 more of those. So that's part A done. We've explained it, we've written down the standards, and we've given our journals where required. Then they're asked just a little tricky bit, part B. You're told your draft net profit here was 585,000. What you have to now go back and think is, right, for all my adjustments, issue 1 to issue 4, what impacts the P&L? It's kind of bringing it all together. You could have done this at the same time and tracked it as you went. We just left it until the end. So if we come up, this is important to note, issue 1 has no impact on the P&L. Right? Dividends do not go to the income statement. They go straight to the statement of change in equity. So that was a trick one to see, did you put it in or not? No impact there. Issue 2, profits are going down by 200,000 because revenue is overstated, and profits are going up by 65 for the profit or loss on disposal. So we put there revenue, issue 2, and profit on disposal, issue 2. So the revenue is minus 200,000 and this is plus 65. So just tidy up that just to make it easy to understand. So that's important that you can see, not only give the journals, but you understand what impact that will have on financial performance, i.e. through your profit line. Issue 3 then, no impact for the contingent asset. Profits down 60,000 because of the provision. So the provision, issue 3, minus 60,000. Tidy that up as well. And then issue 4. So you see the way you had to remember, if you forgot the depreciation, you'd lose marks in part B because that impacts, of course, the P&L. So none of these impact the P&L because they're just capital items on the statement of financial position. Depreciation does. So depreciation, issue 4, and then finance costs, which is the unwinding, issue 4 as well. So it's tricky enough that you can try and bring it all together, but that's what's expected of students in the exam. Debit is an expense, and a debit again is an expense. So your updated net profit for ROI is all of those added together, which is going to be 46,735. So that was a kind of standard you'd expect maybe of a question 2 or 3 in the traditional AC220 exam for about 20 marks. So it's important that you know your standards because any collection of standards can come up there, like an IAS16 can pop up, an IAS10, and that you can bring it all together if you're asked to redraft the net profit as well. That's a good question and a good practice of 37 and 10. So we'll now move on and we'll have a look at question 2 in the tutorial. So we're now looking at Yelkin, whose financial year end is 31st December 2018, and they've not yet been authorised for issue. So we're in that IAS10 period post year end. And we're asked here, prepare the necessary journal entries to account for each of the above issues and explain in accordance, so they give you the question IAS10, the rationale behind journal entries you make for 1 and 2. So we'll do A and B simultaneously as we hit each of the issues. So we're going to start off then question 2, issue 1. On the 1st of January 2019, be careful now, it's a new year, the first day of the next year, fire destroyed a plant carrying 140 grand, and they have an insurance policy to cover fire in full. What they've done then is they've written off to the P&L 140, they've written off the plant and equipment, and then they've recognised the 140 coming in as income from the insurance policy. Now the key point is here, this happened after the year end. So you have to make a call, is a fire that destroyed a plant an adjusting or non-adjusting event? So if we come to question 2, and this is issue 1, so we'll just do A and B together. In this case, this is IAS10, this is a non-adjusting event. This did not give more information about a condition that existed at year end. So the key point here is this fire wasn't there at the year end. It's not that it's giving you extra information when something happened. This was all after the year end. So what you need to do is reverse all entries. Should be disclosed only. So when you have a non-adjusting event, you should only disclose only. Right? You shouldn't be adjusting for that. So the simple entry here, which answers A and B, is to reverse all of these. So you're going to credit admin expenses, you're going to credit trade receivables, you're going to debit PPE, and you're going to debit deferred income. And that's the simple entry here, and it's 140,000 across the board. So all you're doing is reversing those entries, and to explain your logic, the logic is there that this is a non-adjusting event. The fire happened after the year end. It is important, therefore it has to be disclosed, but it wasn't reflective of a condition that was there at the year end, which would have made it adjusting event. So what we look at then is we have those entries done, we've reversed the journals, and that's our answer to part A, or issue 1, in terms of what's required. Issue 2 then, a trade receivable which owed Yelkin 9,000 at the year end was declared bankrupt after the year end, 8 days into the new financial year end. They don't expect to receive any money, so they decided to net it off against the general allowance for bad debts. Right. So again, the question is here, is this an adjusting or non-adjusting event? Issue 2. Now in this case, this is an adjusting event. This gives us more information about a condition, i.e. the trade receivable, that existed at year end. So that's the difference here, is this money was owed at the year end, and we know 8 days later the company was declared bankrupt. So more than likely under IAS10 we say is that company was a bad debt at the year end. So you do adjust the accounts, you don't just disclose it. What's wrong here is when you have a bad debt, you don't hit it against the allowance for bad debts, you put it against bad debts directly. So that should be credit allowance for bad debts and debit bad debt expense. So you shouldn't be debiting the allowance, you should be debiting the expenses, and that is the full 9,000 because you don't expect to get anything when this is written off. So again, what we're looking for is, you know it's IAS10 and you use the language around an adjusting or a non-adjusting event. The reason this was an adjusting event was that the condition existed at the year end, you're just getting more information after the year end. Issue 3 then, at the 4th of January of the next financial year, you made a sale of 200,000, but the customer has since notified you that they're unhappy and they're looking for the goods to be returned and a full refund being given. So at the year end, what they've done is they've debited cost of sales 200 and they've credited the refund. Now what you have to realize here is this sale was only ever made after the year end. There's nothing to do with 2018. So there should have been no entries in 2018 for this particular sale. This is all after the year end. There's no condition that existed at the year end. So what we say here, issue 3, as the sale took place after the year end, it has nothing to do with 2018 accounts. So what you do is you reverse the entries made. That's all you do. So it's a tricky one, but you have to watch for the date. Because the sale took place after the year end, it's nothing to do. If the sale took place in 18, it'd be different because you'd have to account for the possible refund. But here, the sale only took place after the year end. So the sales wouldn't be in 2018 anyway. So you're going to credit cost of sales and you're going to debit what they call refund payable. And that is 200,000 and 200,000. So a nice easy one again, but you just need to know the principles, and more importantly, you need to keep an eye on the key dates as well, which is very important for IAS 10. So your last adjustment then in these questions is inventory costing 12,000 was found to be close to its perishable date, so it could be fresh fruit and veg and whatnot, at the year end. 5 days later, it was sold at a 30% discount to its normal selling price. Yelkin's selling price is based on markup of 40%, and this is the entry they made. Now, this is similar in logic to issue 2, in that the sale of inventory at a lower price after the year end gives us an indication this inventory should have been written down at the year end. So this is what we call issue 4. This is an adjusting event. The sale of the inventory just after year end at a low price gives us an indication that the inventory should have been written down at year end, i.e. This is the language they use in the standard. A condition that existed at the year-end date. So what an adjusting event says is you're getting new information after the year-end that tells you about something that was there at the year-end. So we had the inventory at the year-end. We know they're close to a purchase amount. So we need to figure out what was our net realizable value. The cost we're told is 12,000. What was the NRV, or what were they sold for in January? So what were they sold for? Because that gives an indication what their NRV was at the 31st of December. Now this is important to watch, be careful here. You're told they were sold at a 30% discount on its normal selling price. So there's a couple of things here. What is the normal SP? The normal selling price here, this is where you have to be careful. They charge a markup of 40%. So your normal selling price would be 12,000 times 1.4. Because that's what you mark it up on cost. The actual selling price in January was at a 30% discount. So they sold it at 70%. 30% discount. So you're saying that in RV in January, what you sold it for was 11,760. What it costs, what it's in the account is 12. So it needs to be written down. So this is linking there to IS2. So IS2 is playing a part there, lower of cost to net realizable value. We know what the cost is, and we're using the information after the year end, i.e. the sale under IS10, to inform what our NRV should be at the year end. And that was quite tricky. So what they have done there is incorrect. They've actually increased the inventory and decreased cost of sales, which is completely the wrong answer. So you're going to reverse that. You're going to credit inventory in the SOFP, and you're going to debit cost of sales. And we're going to say the reverse incorrect entry. That's your first point. And that is 3.6. So you're going to reverse them. And what you do instead is you write down inventory. You're going to credit inventory in the SOFP, 240. And you're going to debit cost of sales, because that is an expense, 240. So don't forget now, you have to make sure you reverse the entry as well. Watch for entries that have already been made. If you miss out on those, you're going to get caught and of course lose marks as well. So the key thing, don't just take the numbers as a given. Use the information here to work back. So you can see IS10 can link into other standards and issues as well. So it's an important one that you do understand. So that's finishing A, and we've done B already. We've explained them as we went through. So the key, that was covering IS10, looking at the difference between adjusting events and non-adjusting events.